Appreciate everybody joining us. My name is Adam Watson. I am a UT Extension Agent for Agriculture here in Washington County, Tennessee. And tonight we are going to be talking about the tax implications for our ag producers related to Hurricane Helene and all that comes with it. So we have two guests tonight, Dr. Tori Griffin and Ty Wolaver, and we will ask, I think, this evening for Ty to get started with us. He's going to tell us a little bit about his position as a managed farm specialist. And with that, Ty, introduce yourself and kick it off, sir.
Yeah, thanks so much, Adam. Yeah, so as Adam said, I am an extension specialist within farm management at the University of Tennessee, and essentially all that means is that I am an extension agent that's kind of a one-trick pony, is usually how I describe it. Is we focus on purely the financial side whenever it comes to farming and the extension program. So Dr. Tori Griffin, who you will hear from in just a moment, is in the same position that I am, except she is in Middle Tennessee. So I cover the Northeast Tennessee area from Sevier County all the way up to Mountain City and Johnson County. And essentially what we do is just like any other extension agent, we come to you on your schedule and sit down with you completely for free. And completely confidentially, and go over how to set up record keeping systems specific to your farm, financial analysis of your previous production, or try to predict based off of the resources that you have how production might look like in new enterprises that you're getting ready to start. We also can do some long range planning along with that financial analysis, and then just see how different scenarios might look like on your farm. So should I do cow calf? Should I do stocker? Should I raise fruit and vegetables? If so, what kind should I do, and how that might work for your specific operation? Um, with that, if you want to reach out to me, if you want to set up a meeting on the farm, or just look at not only some of the different things that we might be able to set up for your farm specifically, but how that might look like after the impacts now since Hurricane Helene has come through, I would be happy to do that. My contact information is on the screen. Feel free to text, call, or email me at any time, and I'd be happy to sit down with you. With that, I guess that's all I really have to say. Next up speaking is, like I said, another extension specialist in farm management, Dr. Tori Griffin. She's been here right as many years as I have, almost 4 years now, Tori. And she is our tax specialist. So when Adam reached out to me about this, I said I would love to talk to y'all about some of the tax implications, but I have someone that can know it way better than me. And with that, I'll let the two of y'all have the floor over. Thanks for letting me introduce myself tonight.
Okay, Dr.
All right. Thank you, Adam and Ty, for the introduction. You just, I will concur with everything that Ty just said, that he is a true resource up there. Side. Adam is for the production side. He's your county agent. Ty would be that financial specialist. They are both true resources, whether it is how to handle this post Helene, how do we handle these situations, how do we try to get our production back, how do we actually. Both of them are resources that would be more than willing to. I think I can speak for both of them in that they're both willing to help you in any way that they really appreciate the opportunity to speak to all of you tonight. If you have any questions, please feel free to put them in the chat. You can ask, I think, via just talking. I think we have speaker privileges to the participants. If any of you haven't, please feel free to ask. I will do the best that I can to answer those questions. We're going to hop into this, and one that you're going to see right here is my tax disclaimer that I always give when I do this presentation. So Ty said that I was for our farm management team. I had the opportunity to take over that role after Alan Galloway, our true tax guru, retired last April, and I was kind of asked to fill his very big shoes in that realm, and I have truly enjoyed this opportunity to fill this specialty area for us. But with that, I also still am learning. This is the tax disclaimer that I always give. I am not a CPA. I am not a tax professional, a tax accountant. The point of these presentations and their intent is to not give you specific advice for your operation, but their topic areas or subject matter that you can take to a well-trained tax preparer or a CPA and say, hey, I heard about this option when I'm filing my tax returns. Does this apply to my farm? Does this apply to my specific situation? With these presentations is it's not to offer specific tax advice directly to your farm, towards your farm, but it's to offer that you can be aware of what is out there for you, especially with when we're dealing with post Hurricane Helene tax going on in that area that everybody's trying to deal with. And when we're thinking about tax returns, if we're being honest, that's the last thing we want to worry about, that we want to worry about being taxed for things or taxed more than what we should be. So that's the point of this, is to give you these areas to think about when you are trying to file these tax returns.
Okay, so we'll get into the topics tonight. This is just kind of a rundown. I know that it looks like a lot of topics that we're going to be talking about. However, don't stress. It's just going to be a, we're going to hit kind of the sky level of these and where we're going with this tonight. Again, just giving you that information so that you are aware. So with that being said, when we're talking about this, this was released from the IRS, more than $20 million now in the hands of Tennesseans recovering from the tropical storm Helene in the following Tennessee counties. And with that being said, we've received a lot of questions as agents, as I know tax preparers from the area have received these. And the first one is the question that we receive is, do disaster grants or payments have to be paid back? And with that one is no. When you receive these grants or payments, typically we're in these declared disaster areas. When they are relief payments, they are not having to be paid back in any way. If they have to be paid back, you will know it before you accept it. That is typically never the case, never the situation, but you will be made aware if something ever did have to be paid back in this situation. But the one that we've received the most of is, do I have to include those payments as taxable income? Now, when we're talking about very specific disaster relief payments. And as an economist, I'm going to say typically it depends. However, when we're talking about disaster relief payments, according to this that you received from FEMA, according to that IRS publication 525, you are able to exclude from your income, from ordinary income on your tax returns, any amount that you receive that is a qualified disaster relief payment. Now, if you notice, I keep saying that disaster relief payment. That is very specific terminology that IRS uses, and in order for you to not have to pay back any type of relief payment that you receive, it has to qualify as this. So how in the world does a payment that you received qualify as a disaster relief payment? When we're talking about that, is there are these 4 bullet points that you see here. And I know that this has a lot of words on it. I typically do not like presentations that have this many words on it. That's typically what I strive to avoid. However, I'm going to send this PowerPoint to Adam afterwards so that you have it. But I wanted to get all this information on here directly from the IRS website, from FEMA website, so that you can read it and understand exactly what it says per the source, not just a summary of it. But we've got these 4 bullet points right here. And when we're looking at them, in order for it to qualify as a disaster relief payment, typically when we think of situations, a qualified disaster is this first bullet point. It's typically always going to check this. For what has happened with the tropical storm Helene, with Hurricane Helene, it meets that first requirement right there to reimburse or pay reasonable and necessary personal, family living, or funeral expenses that result from a qualified disaster. Now, we met that immediately with the situation that has occurred in East Tennessee, but there are some situations that or natural disasters that occur that may not qualify for that one, but they hit one of these next bullet points. But if you notice here that I've kind of got bold in a majority of these, is this: it's a result from a qualified disaster. Now, I know that we've said that we have the disaster relief payment. What does that mean? We're kind of going to shift now to, what is this qualified disaster? What does that look like when we're talking about this situation? And when we're talking about a qualified disaster, there's these 3 points that it has to make: a disaster that results from a terrorist or military action, a federally declared disaster, or a disaster that results from an accident involving a common carrier or from any other event which is determined to be catastrophic by the Secretary of the Treasury. FEMA, East Tennessee was a federally declared disaster area. So again, there is no problem in showing this proof of it being a qualified disaster. And we're going to talk a little bit later on in this presentation about having to show that proof of a qualified disaster when we're trying to avoid paying more tax than what we should, or deferring taxes. We'll talk about that and making sure that we can show that proof of a qualified disaster. And I do have this note up here, is that, again, we could exclude that amount to the extent any expense it pays for is not paid for by insurance. We're going to talk about that a little bit more later on, about how we handle these payments versus insured payments as well when it comes to that taxable income. But again, what these payments are is it's to pay for those expenses, to cover living, to cover rebuilding back, potential funeral expenses. All of these are counted under these disaster relief payments. The next one that I want to talk about is that we've received some questions about this disaster mitigation payments. These are different from disaster relief payments. When we're talking about these disaster mitigation payments, that again, you don't have to pay these back, but what they are is that it's not to pay for your day-to-day expenses or to build back, say, for instance, if we're a livestock producer, to build back a barn or to build back our personal home. Disaster mitigation payments, their intent is to reduce the severity of potential damage from future natural disasters. Now, I haven't heard that much. I kind of asked around before this just to see about I haven't heard of a lot of mitigation payments that were received through Tropical Storm Helene in Tennessee. Now, if we were talking about Florida, that would be a different situation. When Hurricane Helene hit there, mitigation payments are common in that area simply because it's going to mitigate the severity of future hurricanes, where typically this is a normal occurrence. Every year there could be potential hurricanes hitting those Florida coastlines. So again, I haven't heard a lot about mitigation payments for East Tennessee. Again, if you've received them, you typically don't have to pay them back. But one thing with that, you do not have to pay them back as long as you do not increase the basis or adjusted basis of your property. So what that means is you can increase that value of it technically with this disaster mitigation payment. With the relief payments, the disaster relief payments, you can increase that basis and not have to pay it back. But with the mitigation payment, it's to reduce the severity of those future disasters. So we've talked about the disaster relief payments and the disaster mitigation payments. The questions that we get asked a lot about this is, what income is going to be taxed? We've talked about those payments. They're not taxed, but what happens if I had to sell more livestock than what I normally do? Is that going to have to be taxed? Or if I receive an insurance payment, does that have to go in my tax return as income? How do I handle these situations? And that's going to be the majority of tonight's presentation. And how we handle this is, what can be taxed? How do we tax it? And are there ways to avoid being taxed more than what we should be by properly reporting information in the appropriate places? So when we're talking about, I've kind of got it sectioned off here in 3 different sections. And the first one is that ordinary income. And that's going to be our sales from livestock, sales from grain, sales from timber, anything that we are doing that this is our short-term capital gains, assets that we've had less than a year that we can sell, and how do we approach those? Now, what we want to do and what our goal would be is that we want to get as much of our income out of this ordinary income situation as we can. And I'm going to show you one of the reasons why here in a second. And we want to try to move it into that capital gains income section. But if we can't move it out of the ordinary income, we do have some options with that to not have to pay as much this year as far as taxes go, or ways to lessen our amount of taxable income given the situation that you may be in of having to sell more than normal from Hurricane Helene. But the reason why we want to get it out of that ordinary income bracket is because right here, I show you these, I've got these tax rates right here. This is a slide from the typical farm tax presentation that I give, is that ordinary income can fall in any of these tax brackets that I have, ranging from 10% to 37%, depending on where your amount of taxable income falls after that standard deduction you receive. Now, again, these are some pretty, when we look here, I only have 10, 12, and 22% section out here to show you how the brackets fall. But we can get into that if we've had to sell more livestock, especially if we're talking about cattle right now. Prices are very bullish. We're in a situation that we could potentially, if we've had to sell the majority of our herd or more than what we normally do in a typical year, we could reach these higher tax brackets in those situations, and we don't want to pay that additional ordinary income tax because of having to sell more than what we needed to, given our current situation. But I wanted to bring that up, and what we want to try to do, though, is take that ordinary tax income, if possible, if we can. So right here, when I have this up right here, when we're talking about properly reporting where income goes or reducing that ordinary income is, I've got this Schedule F. Majority of you have probably seen this before, and we know that we would put, if we're a cow-calf operation, or if we're a sheep operation and we raise our lambs or we raise our calves, they're born on our farm, and then we sell them, they're going to go in that line 2, that sales of livestock, produce grades, and other products you raised. But the question is, and what we've seen a lot is that not only are we having to sell those feeder calves that we have, those short-term capital assets, but we're also having to sell those mama cows or that bull that we've seen, that we don't have the opportunity now to keep our entire herd because fences are down. We don't have the necessary hay through the wintertime. That was an issue that I know that we heard a lot of producers facing at times, is where does that income go from selling those breeding livestock? How do we handle that situation? And what we typically see here is when we're talking about reporting these livestock sales is that we've talked about you would put your calves on this, whether you raised them and purchased and resold them, you would put those calves on this Schedule F. But that breeding livestock is not going to go on this Schedule F. It's not going to go under this other income line where we see a lot of times filing these tax returns where we see that go. It's actually going to go on this capital gains form, this Form 4797. Now, with that being said, you may have seen this before, given if you've sold pieces of machinery or equipment. This also is where you put your breeding livestock on here. And when we're talking about this, the reason that we put breeding livestock, we're able to put it on this Form 4797 is because it is considered a long-term capital asset for our operation. If we ended up selling our mama cows or our bull, we can't necessarily continue our operation until we purchase those assets again to, again, have that calf crop. And the reason that we want to put it on this Form 4797 instead of that Schedule F is because gains reported on this, income reported on this, is not subject to self-employment tax. That self-employment tax is 15.3%, and that's in addition to whatever the ordinary income tax bracket that you fall into if you put these sales on that Schedule F form. So again, we want to make sure that we're putting it on this Form 4797. Now, there are stipulations when we're talking about this in normal circumstances, is that an animal, if we're talking about cattle, they have to be owned on the farm for 2 years or longer in order to be put on this form. Sheep and goats and all other animals, 12 months or longer. That is a requirement when we're using this Form 4797 in normal circumstances. Now, as we all know, this is not necessarily a normal circumstance. There is an exception to that holding rule when a weather-related condition has caused the sale of additional animals than in a typical year. They typically, when they say a typical year, they look at the previous 3 years. And we'll look at some examples here for this as well, but if typically you sell 10 replacement females, 10 mama cows a year, and then this year you had to sell 25, then you can continue, you can actually put those 25 that are on this, you can put them under this Form 4797, even if you did not hold them for 2 years or longer. You meet that holding period exception because it is more than your normal practice. So again, we don't want to put on Schedule F because we want to avoid that additional self-employment tax by filing under that Form 4797. Kind of moving back to this ordinary income is that, okay, what if we cannot use Form 4797? There's a situation that we still have ordinary income. What can we do in this situation? And there is a deferral of income option. It's the Internal Revenue Code Section 451G. There's two options that we're going to look at here. And the first thing that you need to understand with this is that any livestock can be sold due to weather-related conditions, and you can use this deferral of income as long as you meet additional requirements under this. And we're going to talk about those. There is another involuntary conversion. We're going to talk about that. There are specifics that go along with that one, that it is not any type of livestock, that there are specific livestock that can only fall in that. We will talk about that in depth here in just a second. But what this deferral of income allows you to do is you can have that 1 year postponement of gains from sales of livestock. And I did put this in here. This does include poultry when we're talking about this, is that you can defer that income until the next year so that you don't have those additional income that you may not normally have in a typical year. The requirements that go for this, though, is the first one is that you must use the cash accounting method. I am easily able to say probably 95% of farmers in Tennessee, I would almost say 98% of farmers in Tennessee use the cash accounting method, that they are recording income and expenses when they occur. Expenses when they're paid out. Income is when they receive the payment for the service. That is the cash accounting method. Most farmers keep their records that way. So that is not an issue that we need to be concerned about. The one that we do have to pay attention to, though, is this requirement that the taxpayer, more than half of their income must be from farming. Farming must be their principal operation. And so when we're talking about this, the example that I like to give is if we are a teacher and we have a $50,000 salary that is from off the farm, but then we also bring home $20,000 from our farming operation. We could not use this deferral of income option. We could not use this Section 451G when we are looking at this. That is not the case for the next option that we'll look at. It does not matter for the next option. It does not matter what percentage of farm income it is, whether it's 50% or whether it's 10% of your total ordinary income. There is not that requirement for the next option that we'll look at. But the deferral of income, it's similar to the Form 4797 holding period exception. They're going to look back on the previous 3 years, and they're going to basically take your average of what you typically sell in those 3 years, and if you have sold additional livestock beyond that, they will look at that, or additional, whatever the income may be coming from. They're going to see what your sales look like. Weather must have caused the sale. This is not something that you would have to stress about. The area or the county must have been declared eligible for federal assistance. Again, we meet these stipulations pretty easily. The reason that they put these last two requirements there is because sometimes it's not as easy to show that proof that whether caused the sale of the livestock, or if there's not necessarily a declared, it's not a well-known federal disaster. And what I think of when I think about that is drought. Sometimes there are federally declared disaster areas due from drought. Not everyone may know that. That doesn't make the news as publicly wide as Hurricane Helene did, or flooding, or a tornado would have. So again, those last two bullet points are simply for the reason of sometimes it's not as easy to prove the reasoning for the sales, or it may not be as well known that it has been declared eligible for that federal assistance. So, and I wanted to show this for you right here is, again, there is no problem with showing that proof of the weather-related sales of being a federally declared disaster area. This area, all of you know this, it has been designated as this. This is, again, not a problem that we would have to show. We're trying to use these methods. So the example of deferring income, I wanted to give actual physical examples for all of you to see how to handle these situations and different options for you. So I have this example right here. Again, beef cattle, that's what I'm most comfortable using typically, but again, you can use this for any type of livestock. Deferral of income is any type of livestock for your operation. So Ray Moore normally sells 100 head of beef calves each fall. As a result of the federally declared drought for his county and state, he sells 150 calves and realized $120,000 from the sale. If Ray meets the requirements of the IRS Section 451G, he can elect to postpone the gain of $40,000 on 50 head of beef calves. So only on the number of calves that he would not have sold during the current year, he can defer to the next year. So what we see here is that he had an additional gain of $40,000 from those extra 150 calves that he sold, from those extra 50 calves that he sold due to this drought. So again, the requirements that he has to meet, again, it's any livestock, he met that one. The federally declared disaster area, the drought for his county and state, and then he has to be, his primary operation has to be farming. His principal business has to be farming. The majority of his income for the year has to come from that farming in order for him to use this. So if he meets those requirements, he can take that $40,000 of income and defer it to the next year in order to not have to pay that additional amount of income, whatever. And this could increase potentially his tax bracket that he falls in, whatever percentage of that might be, with that self-employment tax and that ordinary income tax. So if we so choose to make this election, if it's any livestock, if farming is our principal business and we chose to make this election, how do we handle this situation? How do we let our tax preparer know? There are a few things. You do have to attach a statement to your tax return in order to make this election. It has to have your name, address, and ID number. It has to have a statement that you are electing to postpone the gain under IRC Section 451G. Again, your tax preparer, a tax professional, can help you in this situation to make sure that you are properly electing for this and providing all the information that you need. That evidence of weather-related conditions that force that early disposal of that livestock, again, not a problem for anybody in this area, in that East Tennessee area that we showed earlier. The explanation of how the sale is related to weather conditions, again, not an issue for this. These requirements are in here for those. Again, the example I give is drought. And then the next things that are important is that the number of livestock of each kind that would have been sold or exchanged under normal business circumstances. Again, the average number of animals that you're selling over that 3 preceding years. And then you have to not only show what you typically would sell, you have to also list the total number of animals sold in the current year and the number sold due to the weather-related circumstance. Again, we can't defer income on livestock that we would have sold regardless whether this weather occurred or not. Whether this disaster happened, we were still going to more than likely sell our calf crop for the year. We have to make sure that we're listing what would have been sold in it, what was sold in addition to what would normally be sold. And then at the end of it, what you need to is the amount of income to be deferred. In our example, it was $40,000. That was what he would be requesting to have deferred until the next tax year. Again, he's not, for this example or for any of you, we're not getting out of paying taxes on that income. That's not what we're doing with this election. But what it is making sure is that we're not adjusting and raising our tax bracket by having more income than what we normally would have. That we're not adding additional income that we typically wouldn't see in a normal year, and that we're not having to pay more in a percentage-wise on that. We're not avoiding paying the taxes on it. We're just deferring it until the next year so that we don't have to be in that situation of owing more than what we really should. Moving on to the next option. This is the involuntary conversion. It's IRC 1033E. You might have heard of this if you've ever done a like-kind exchange for real estate property, where a piece of property has the same value as another piece of property that somebody else owns, and both of you would like to swap. This is the form that you would use for that. This is also an opportunity during a natural disaster that you can use this involuntary conversion option. And what this does is that it's when a property, and this isn't just related to livestock, this could be pieces of equipment as well, is where property is involuntarily converted into money or into property that's not similar or related in service. And what this allows you to do is you can defer the tax on that gain, whether it's receiving the money for it or whether it's having a piece of property and you're going to sell it. You can defer the tax on that gain if you replace it within 2 years following the year of the event. The replacement period can be 4 years if it is in a federally declared disaster area. The reason they do this is that it does not always have to be a federally declared disaster area to use this involuntary conversion option. So as long as you are taking that piece of property and you're replacing it within 2 years, you may defer the tax on any gain with that, if there is any, after you replace it. The cost of the replacement property must be equal to or more than the proceeds from the converted property. So if you did purchase a piece of equipment, and we'll look at an example, if you purchase a piece of equipment and the value of that equipment is less than what you received in lieu of that initially, the proceeds from the converted property, you would have to pay the difference between that. That would have to be paid. A tax would have to be paid on that. Now, if we remember with the 451G, any livestock could be, the income from that livestock could be deferred. To use involuntary conversion, it must be replacement, draft, breeding, or dairy livestock. These are the specifics. It cannot be any type of livestock when we're looking at this. So, for example, stocker calves. We could not use involuntary conversion for this situation to use for IRC 1033. Now, the stipulation for this one, though, the caveat with this, we don't have that half of our income or more than half of our income has to be from farming. So we have the livestock requirement, but we don't have to have the principal operation is farming with this. We give and take with each one, with each opportunity. But if we did want to utilize this option, report of this involuntary conversion would go on that Form 4797 that we had talked about for the breeding livestock, for the pieces of machinery and equipment. So if we want to use this, what are the requirements for this? The first requirement, again, is the evidence of weather-related conditions. Again, not hard for us to prove given our current situation. The next one is the calculation of amount of gain realized. So this is the price that for the purchase, and then the excess amount that we've received from this. So again, if the value of our livestock was less than what we were given in monetary amount, we would have to show that gain on that Form 4797. And then again, we have to show this number and kind of livestock sold and the number and kind of livestock that would have been sold under normal business conditions. Now, I do want to give an example with this, is that, and kind of going back here, is that one of the things with this that I want to note with this is that when we're talking about the number and kind of livestock that would have been sold under normal business conditions and the number and kind of livestock sold, when we're replacing them, we do not have to replace the exact amount, the exact number that we sold. So if we sold 10 mama cows, we do not have to replace and go back and purchase 10 mama cows again. What we have to keep the same is the value, that we have to replace the same value for that. So again, cattle prices right now, they are extremely bullish. We know that cattle prices are extremely high. We may not be able to give when we are ready to go 2 years down the road and purchase this. We may not be able to buy 10 cows for the value we received for those when we sold them in 2024. We may not be able to receive that. We may only be able to purchase 7 or 8 given what we received for those. Again, it's the value, not the number of head that we're replacing. We have to keep the same value, not the same number. So an example right here. We have Johnny Jones' machine shed was destroyed by a tornado in February of 2022. The destroyed machine shed was 5 years old, but had a zero basis because Johnny took bonus depreciation on the structure when it was originally constructed. Johnny received a $100,000 insurance settlement to replace that machine shed. If the shed is replaced for $100,000 before the end of 2024, so remember, 2 years, we have a 2-year replacement period, he is not required to claim payment as income. So exactly what we said, we're replacing the same, we received a payment, we're replacing the machine shed for the exact same value. We do not have to claim that payment as any type of income because we've used the same value. If the shed is replaced for $120,000, so we've received an insurance settlement of $100,000, we did some upgrades to it, and now we replaced it for $120,000. A new basis will be created, and he can actually begin depreciating that $20,000. So he spent a little bit more, but he has this opportunity now to deduct his expenses through depreciation, given this with this additional $20,000. This is the one that I want us to make sure that we see, though. If shed is replaced for $75,000, a $25,000 recognized gain is reportable on Form 4797. So he received an insurance payment of $100,000. He only spent $75,000 of it. This is a situation where that insurance payment would be reportable income, and it would have to go on that Form 4797. Now, one thing that I want to show here is that if plans to replace the shed change, so he received that payment in 2022, he has 2 years for that replacement period. If he gets to 24 and he decides, I don't need this machine shed, I realized I've done fine without it, it's not really necessary, he has to go back and he has to amend that 2022 tax return to include that income from that insurance settlement to make sure that he is actually being taxed for that income. So again, we have to make sure that we have our appropriate plans. We don't always have to use the same value that we received for that insurance settlement or that piece of property, whatever value it may be that we've received from it in whatever way it may not be an insurance settlement. It may be selling another piece of property. But we have to make sure that we are appropriately, we're not trying to get out of paying the income tax on it, but we are trying to either defer it or adjust when we pay it potentially, depending on our situation. So that again is the two options when we're talking about the 451G and then the deferral of income and then the involuntary conversion. Now, you can swap between those two in one way. And what I mean by that is that you can defer the income and then later on use Section 1033, IRC Code 1033, that involuntary conversion. However, what you cannot do is you cannot use involuntary conversion of 1033 and then the deferral of income. You cannot do it that way. You cannot do it in reverse. But those are the two options. Again, the deferral of income, that is for producers whose main business is farming. It's for any type of livestock. You can utilize it, and that defers your income to the next tax year, so you potentially don't have to pay more by falling into a higher tax bracket. The other one, the involuntary conversion, if you receive, for example, an insurance payment, it allows you to defer that tax on that gain by replacing it, giving you that 2-year replacement period. So now that we're on this, we keep talking about these insurance payments. How do we handle these again? We've talked about the involuntary conversion, but what about these taxing of these insurance payments? If a loss is caused by a federally declared disaster, you are able to deduct personal casualty losses relating to your home, household items, and vehicles. You are able to count that as a loss. However, you cannot count that as a loss if you received an insurance payment for it. Or if it was fully insured, you cannot deduct any type of loss for that. You can reduce the loss by the amount of the reimbursement, and we're going to look at an example. But you can take off some of that, again, but you have to make sure that you are not utilizing a loss if you received payments for it. So the example right here, we have Joe Smith. He owns a barn that was damaged in a hailstorm. In this case, the hailstorm damage was limited to only the roof. Joe received a $30,000 insurance payment for the damage. Joe, in turn, hired a contractor to repair the roof. The repair bill from the contractor totaled $35,000. Since Joe spent more than the insurance proceeds on the repair, he's not required to claim any of that insurance payment as income. So this situation, he spent a little bit more. He doesn't have to claim any type of payment as income. He'll add $5,000 to the basis of his barn for this. Now, what if he had only spent $25,000? He's going to have to claim that $5,000 of insurance payment as ordinary income. He doesn't have to claim the whole $30,000. That is not, because he did utilize it to repair that roof on the barn. But he is going to have to claim that $5,000 of additional payment for this in this situation because he did not utilize it and it was income. So that is the situation that we've talked about, these specific opportunities that you have. Again, we've talked about the disaster relief payment, the mitigation payments. We've talked about those situations of we have to pay those back in those situations. We've talked about how we want to shift, if possible, as much from that ordinary income into the Form 4797 so that we don't have to pay that additional self-employment tax. But if we can't shift it out of that ordinary tax income, what are our opportunities then? And we've talked about deferring the income. We've talked about if we receive a payment, replacing it, that we have this opportunity to not pay tax as long as we intend to replace the property that was involuntarily converted into cash or another piece of property. These are the options that are available to you. I have put on here, just so that you have it, a lot of this information is in these resources, and these are links. As I said, I'm going to send this to Adam so that you have these links to click on, and I may send him some additional tax information as well related to weather-related disasters and information that has been published from other universities on this subject matter. But these are great places to start if you're trying to figure out, how do I go about this? How do I handle these? If you need to take this to a tax preparer to say, hey, I need to use this Form 4797. Here's the information on it. They can find it as well, but sometimes it helps to just go ahead and hand it, especially if they don't have a lot of that experience in the agricultural industry. But with that, Adam, that is the presentation we have. And I will open it up to any questions if there are any. And again, as I gave my disclaimer, if I don't know the answer to it, I will very gladly say I don't know, and I will get you the answer, because I never want to give anybody incorrect information.
All right. Thank you, Tori. Thank you very much for that. What we will do is, if you have a question, you're welcome to put it in chat. You're also more than welcome to unmute yourself. So if I remember correctly, if you're on like a laptop, if you hold your space bar, that will temporarily unmute you. Or if you're on a phone or other smart device, you may have to swipe up, down, left, right to find that option. But we'll pause just a moment and see if any of the audience has specific questions for you.
Adam, were you able to hear me okay?
Yes, yeah. Volume was perfectly acceptable and good. Yeah, that was a good switch to make. So I'm watching the chat. Let me just say and reiterate this. If you signed up, I've got your email address, so we'll be able to get you those resources. This will also go up on YouTube. So if you know somebody you think could benefit from it, please feel free, forward them the email, let them have the resources, find the YouTube video. The more people that give this information, the better. And certainly just keep in mind, Extension is a resource for you. So as you have questions come up, you may very well ask your local county agent, and we may say, I don't know, but we do our best to find out. And so we're calling people like our managed specialist and others to find those answers for you. But hopefully this gives you an idea of some questions you can take to your tax preparer and hopefully get the best result for you this tax season. I am not seeing anything in the chat. Ty, you're welcome. If there's anything you would like to add, feel free to do so.
It was great. Appreciate it, Tori.
Agreed.
Hopefully it was the information that y'all were wanting, and hopefully it provided some information to producers as well.
Absolutely. I think they'll find it useful, and hopefully it may very well generate some more follow-up questions. So you might be hearing from some folks, but hopefully this will at least get people started in the direction maybe they weren't thinking before too. And as always, if you've never utilized the managed specialist, reach out to Ty, let him help you to look at the business side of your operation, particularly if you're looking at what is my operation going to look like as a result of Helene? What are some options? What are some choices? He can help you basically run some numbers, look at some scenarios on what you might choose. So you might find him to be very useful as you're looking at making some decisions for your farm operation. All right. Seeing no questions, I'm going to go ahead and say that we're done this evening. Thank you for joining us. Be on the lookout for that email. I may get everything uploaded tomorrow to YouTube. I'm not going to promise, but at least we'll say by close of business Wednesday, you'll certainly have it in hand. Tomorrow I've got some other things happening too, so I'll see what I can get fit in. All right.
It's a busy time of the year.
It is. It's a very busy time.
Adam. Thanks, Tori.
Thank you both, and thank you for joining us.
Thanks.